Thank you for being here today. People always ask me about getting rich, about making millions, about beating the market. But that's not really what most people need. What they need, what you probably need, is financial freedom. And those are two very different things. Financial freedom doesn't mean you're buying yachts and private jets. It means you wake up in the morning and you don't have to worry about money. It means you can make life decisions based on what makes you happy, not on what pays the bills. It means that if you want to take a year off to care for a sick parent, or start a business you're passionate about, or just spend more time with your kids, you can do it without financial stress. And here's the secret that most people never figure out. Financial freedom comes from passive income. It comes from owning things that pay you while you sleep. It comes from putting your money to work so hard that eventually your money works harder than you do. I'm 95 years old now, and I can tell you with absolute certainty, the path to financial freedom isn't complicated. It's not about finding the next hot stock or timing the market or getting lucky with crypto. It's about understanding a few simple principles and having the discipline to stick with them for decades. Today I'm going to explain exactly how the average person, someone with a regular job, no special connections, no trust fund, can achieve genuine financial freedom through passive income. Everything I'm going to tell you is based on principles I've practiced for over 70 years. They worked in the 1,950 seconds, they work today, and they'll work 50 years from now. Before we get into the specifics, we need to talk about mindset, because this is where most people go wrong from the very beginning. Most people think of investing as buying pieces of paper that go up and down in price. They check their accounts constantly. They get excited when things go up and panicked when things go down. They're thinking like traders, like speculators, like gamblers. That's not how you build wealth. That's not how you create passive income. You need to think like an owner. When you buy a share of stock, you're not buying a ticker symbol. You're buying a piece of a real business. You're becoming a part owner of that company. And as an owner, you should care about one thing. Does this business generate cash that it can either reinvest to grow or distribute to its owners? Let me give you an example. When Berkshire Hathaway bought Coca-Cola stock back in 1988, we weren't buying it because we thought the stock price would go up next month. We were buying it because Coca-Cola had an incredible business, a globally recognized brand, a product people loved, a distribution network that reached billions of people, and consistent profitability. We paid about $1.3 billion for our stake, and Coca-Cola paid us about $75 million in dividends that first full year. Not a bad return, about 5.8% in cash. But here's what's remarkable. Today, decades later, we still own most of those same shares, and Coca-Cola pays us over $700 million in annual dividends. Our dividend income from that single investment has grown almost tenfold, not because we did anything clever, but because we bought a wonderful business and held on to it. That's the mindset I want you to have. You're not buying stocks to flip them for a quick profit. You're buying ownership stakes in businesses that will pay you cash year after year, decade after decade. You're building a portfolio of assets that generate passive income. Let me take you back to Omaha, Nebraska in the 1,940 seconds. I was a kid obsessed with money, not spending it, but accumulating it, watching it grow. When I was 6 years old, I bought a six-pack of Coca-Cola for 25 cents from my grandfather's grocery store and sold each bottle for a nickel. That's 30 cents in revenue on a 25-cent investment, a 20% profit margin. I was hooked, not on Coca-Cola yet, but on the concept of buying something and selling it for more. By the time I was 13, I was delivering Washington Post newspapers, about 500 papers a day, 7 days a week. I'd wake up before dawn, deliver papers in the freezing cold or the scorching heat, and I'd earn about $175 a month. But here's the important part. I wasn't spending that money. I was saving almost all of it. I was accumulating capital. At 13, I filed my first tax return. I deducted $35 from my bicycle and watches business expenses. I was already thinking about assets and expenses, about what generates income and what consumes it. Then With a friend, I bought a used pinball machine for $25. We put it in a barber shop and split the profits. Within months, we had machines in several locations generating steady income. I was learning about business ownership, about cash flow, about what it meant to have money coming in even when I wasn't actively working. But the big lesson came when I was 11. I bought my first stock, 3 shares of City Service Preferred at $38 per share. I'd saved up $114.75, which back then felt like a fortune. Shortly after I bought it, the stock dropped to $27. I was terrified. I couldn't sleep. I'd lost over $30 on paper. That was weeks of paper route earnings. When the stock recovered to $40, I sold immediately, relieved just to have my money back plus a tiny profit. Then I watched it climb to $200. That mistake taught me more than any book ever could. I learned about patience, about not letting short-term price movements scare you out of good positions, about the importance of temperament in investing. Every one of these experiences was teaching me the same fundamental lesson. Wealth comes from owning things that produce income. My paper route produced income. My pinball machines produced income. The stocks I bought were ownership stakes in businesses that produced income. So let's be very clear about what we're talking about when we say passive income. I'm not talking about get-rich-quick schemes or magic formulas. I'm talking about income that flows to you because you own productive assets. There are really 4 main categories of passive income that actually work. First, dividend income from stocks. When you own shares in a company, many companies pay a portion of their profits to shareholders as dividends. If you own 100 shares of a company that pays $2 per share annually in dividends, you receive $200 every year. You don't have to do anything. You just own the shares and the checks show up. The beautiful thing about dividend-paying companies is that good ones tend to increase their dividends over time. Coca-Cola has increased its dividend every single year for decades. So has Johnson & Johnson. So have many other quality companies. Your income grows without you doing anything. Second, interest income from bonds and cash. When you own a bond, you're lending money to a company or government, and they pay you interest. A $10,000 bond paying 5% annual interest sends you $500 every year. Now, I'm not a huge fan of bonds at current interest rates. They don't offer great returns, but they're an important part of understanding how passive income works. You're getting paid for letting someone else use your money. Third, rental income from real estate. If you own a rental property, your tenants pay you rent every month. After you cover your expenses, mortgage, taxes, maintenance, insurance, whatever's left is cash flow. Real estate can be an excellent source of passive income, though I'd argue it's not truly passive since you have to deal with tenants and maintenance. But the principle is the same. You own an asset that produces cash. Business ownership. If you own a business or a piece of a business that generates profits, you receive a share of those profits. This is really what stock ownership is, owning a piece of businesses that generate profits. This is my favorite form of passive income because good businesses can grow their earnings over time, which means your income can grow dramatically over the years. Now, here's what's not on this list. Cryptocurrency trading, day trading, stocks, flipping houses, multi-level marketing, selling courses about getting rich, or any of the other nonsense people promote as passive income. Those aren't income-producing assets. They're speculation at best and scams at worst. True passive income comes from owning productive assets that generate cash flow, period. All right, so how does the average person actually achieve financial freedom through passive income? Let me break it down step by step. Step 1, live below your means and save aggressively. This is non-negotiable. If you spend everything you earn, or worse, if you spend more than you earn, you'll never build wealth. You'll never achieve financial freedom. It's mathematically impossible. I still live in the house I bought in 1958 for $31,500. I drive my own car. I don't have expensive tastes. And I'm not saying this to brag. I'm saying it because it illustrates a fundamental point. Your lifestyle expenses determine whether you can save and invest. If you're earning $50,000 a year and spending $50,000, your savings rate is 0. But if you can live on $40,000 and save $10,000, your savings rate is 20%. That $10,000 per year, invested properly, is the foundation of your future financial freedom. I'd suggest aiming for at least a 20% savings rate if possible. If you can do 30% or 40%, even better. The higher your savings rate, the faster you'll achieve financial freedom. Step 2, eliminate high interest debt immediately. Before you invest a single dollar in the stock market, you need to pay off any high interest debt. Credit card debt at 18% interest, car loans at 10%. Pay those off first. Why? Because you can't out-earn high interest rates. If you're paying 18% interest on debt, paying off that debt is a guaranteed 18% return. That's better than almost any investment you'll ever find. The only debt I've ever thought was reasonable is a mortgage on a home you can actually afford, and even then I believe in paying it off as quickly as possible. Debt is the enemy of wealth building. It works against compounding instead of with it. Step 3, invest regularly in low-cost index funds. For the vast majority of people, the right investment strategy is beautifully simple. Invest regularly in a low-cost S&P 500 index fund. I've spent my entire career picking individual stocks, and I've been fortunate to do well. But I'm honest enough to tell you, most people shouldn't do what I do. It requires enormous time, specialized knowledge, and a temperament that most people don't have. An S&P 500 index fund gives you ownership stakes in 500 of America's largest companies: Apple, Microsoft, Amazon, Alphabet, Berkshire Hathaway, Coca-Cola, Johnson & Johnson, all of them. You're automatically diversified. The fees are minimal, often under 0.1% annually, and over long periods, you'll likely beat 90% of professional investors who charge much higher fees. I've recommended this approach publicly many times. I've even instructed the trustee of my estate to invest 90% of my wife's inheritance in an S&P 500 index fund. If it's good enough for my family, it's good enough for anyone. Set up automatic transfers, let's say $500 per month or whatever you can afford, from your checking account into your brokerage account, automatically buying more shares of your index fund. Don't think about whether the market is high or low. Just buy consistently, month after month, year after year. Step 4, reinvest all dividends. This is absolutely critical. When your index fund pays dividends, reinvest them automatically. Don't take the cash. Let every dollar go back to work buying more shares. Over long periods, reinvested dividends make up a huge portion of total returns. Something like 40% of the stock market's returns over my lifetime have come from reinvested dividends. This is how you accelerate the compounding process. The dividends buy more shares, which generate more dividends, which buy even more shares. It's a virtuous cycle that grows exponentially over time. Step 5, be patient and let compounding work. Charlie Munger, my partner for over 50 years, used to say the first rule of compounding is to never interrupt it unnecessarily. That's profound wisdom. Most people interrupt compounding all the time. They panic and sell during market crashes. They take profits and spend them. They switch strategies constantly. They pay high fees that erode returns. They trade frequently and generate taxes. Don't do any of that. Just buy and hold. Let decades pass. Let compounding do its work. Let me show you the actual mathematics of how this works, because numbers make it real. Let's say you're 25 years old and you start investing $500 per month in an S&P 500 index fund. That's $6,000 per year. You earn 10% annually on average, which is roughly what the market has returned historically, and you keep this up for 40 years until you're 65. Here's what happens. After 10 years, you have about $102,000. You've contributed $60,000 of your own money, and you've earned $42,000 from investment returns. After 20 years, you have about $382,000. You've contributed $120,000, and you've earned $262,000 from returns. After 30 years, you have about $1.1 million. You've contributed $180,000, and you've earned over $900,000 from returns. After 40 years, you have about $2.8 million. You've contributed $240,000 of your own money, and the market has handed you over $2.5 million. Think about that. You saved $500 a month, not an enormous amount, and over 40 years, you became a multimillionaire. The market did more than 10 times the work you did. But here's where financial freedom comes in. Let's say you retire at 65 with $2.8 million. Following the traditional 4% withdrawal rule, you can safely withdraw about $112,000 per year without running out of money. That's passive income. That's financial freedom. Even if you're more conservative and only want to withdraw 3%, that's still $84,000 per year in passive income generated by your portfolio of ownership stakes in American businesses. You don't have to work. You don't have to worry about being laid off. You don't have to stress about bills. You have genuine financial freedom. And here's the beautiful part. If you don't need all of that income, you can reinvest some of it and continue growing your wealth. Maybe you leave some to your children or grandchildren. Maybe you donate it to causes you care about. But you have options because you have passive income. Now, maybe you can't wait 40 years. Maybe you're starting later in life, or you want to achieve financial freedom sooner. That's fine. The principle is the same. You just need to save more aggressively. If you save $1,000 per month instead of $500, you can cut that timeline roughly in half. If you can save $2,000 per month, you can achieve financial freedom even faster. The math is the math. The more you save, the higher your returns, and the longer you let it compound, the faster you achieve financial freedom. Let me explain why I'm so passionate about owning productive assets, specifically ownership stakes in businesses, rather than speculation or get-rich-quick schemes. When you own a share of stock, you own a piece of a business. That business has employees who show up every day trying to serve customers better. It has factories producing goods, or software engineers writing code, or stores selling products. It's doing real work in the real economy. And when that business makes a profit, a portion of that profit belongs to you as an owner. You didn't have to show up to work. You didn't have to serve a single customer. But you receive your proportional share of the profits because you're an owner. This is the essence of capitalism, and it's the most powerful wealth-building force in human history. By owning productive assets, you're harnessing the productive capacity of human ingenuity and effort. Compare that to speculation. When people buy cryptocurrency or gold or baseball cards or whatever, hoping to sell it for more later, they're not owning something productive. They're just hoping someone else will pay more for it than they did. That's the greater fool theory. Your profit depends entirely on finding a greater fool. With productive assets, your profit comes from the economic value created by the business. Whether someone else wants to buy your shares for more tomorrow is irrelevant. You're receiving dividends. You're participating in earnings growth. You're being paid to own something valuable. This is why I always come back to owning businesses. Berkshire Hathaway owns entire companies, insurance companies, railroads, utilities, manufacturing businesses. We also own parts of publicly traded companies through stock ownership. All of them are productive assets generating earnings and cash flow. That's real wealth. That's what creates passive income that lasts generations. Let me tell you something that might be the most important concept in all of investing. Time is the friend of the wonderful business and the enemy of the mediocre. What this means is that if you own good businesses and give them time, your wealth will compound at rates that seem almost magical. But you have to give it time, and you have to stay disciplined. I mentioned earlier that we bought Coca-Cola in 1988. We paid $1.3 billion and received $75 million in first-year dividends. Today, we receive over $700 million annually in dividends from that same investment. But here's the thing, that didn't happen overnight. It took decades. There were years when Coca-Cola stock went down. There were periods when people said the soft drink industry was dead, that everyone would switch to bottled water, that the brand was outdated. There were crashes and recessions and all sorts of reasons to sell. We never sold. We stayed disciplined. We let time work its magic. The same principle applies to your index fund investing. There will be market crashes. The market will drop 20%, 30%, maybe 50%. I've lived through dozens of major market declines. The crash of 1987, the savings and loan crisis, the dot-com bust, 9/11, the financial crisis of 2008, the COVID-19 panic of 2020. Every single time people panic, they sell at the bottom, locking in their losses, watching in agony as the market recovers without them. The people who achieve financial freedom through passive income are the ones who stay invested through all of it. They understand that market crashes are part of the deal. They understand that volatility is the price you pay for superior long-term returns. Actually, if you're in the accumulation phase, still building your wealth, market crashes should make you happy. Your $500 monthly investment is buying more shares at cheaper prices. You should be hoping for crashes during your working years. It's only when you need to sell when you're retired and living off your portfolio that market declines become problematic. But even then, if you build a diversified portfolio of quality assets, temporary declines are just noise. The key is discipline. Discipline to keep investing when markets are crashing. Discipline to not sell during panics. Discipline to ignore the noise and stick to your long-term plan. Now let me tell you about the mistakes that destroy wealth and prevent people from achieving financial freedom. Mistake 1, chasing trends and hot stocks. Every few years, there's some new thing that everyone insists you have to own. In the late 1992, it was .com stocks. In the mid-2000s, it was real estate. Recently, it's been cryptocurrency and meme stocks. People see others getting rich quickly and they feel like they're missing out, so they chase whatever's hot, usually right before it crashes. If you want financial freedom through passive income, you need to ignore all of that noise. Stick to your strategy of buying low-cost index funds or quality businesses with actual earnings and dividends. Let everyone else chase the shiny objects. Mistake 2, trading frequently. Every trade you make costs you money. Even with zero commission trading, there are spreads, taxes on short-term gains, and the mental energy of making decisions. But the bigger problem is that frequent trading usually means you're reacting emotionally to short-term noise. You're buying when you're excited and selling when you're scared. That's exactly backwards from what you should be doing. The way to build wealth is to buy and hold for decades. Let me repeat that. Decades. Not days, not months, not even years. Decades. Mistake 3, panic selling during downturns. This is the single biggest wealth destroyer I've seen in my 70 years of investing. People stay invested during good times, but the moment the market crashes, they panic and sell everything. I can't emphasize this enough. If you sell during a crash, you're locking in your losses. You're guaranteeing that you'll never recover. The people who achieve financial freedom are the ones who buy more during crashes, or at minimum, just hold on and do nothing. Be fearful when others are greedy, and greedy when others are fearful. When everyone else is panicking, that's when you should be most confident in your strategy. Mistake 4, lifestyle inflation and overspending. This might be the most insidious wealth destroyer because it happens slowly and people don't realize they're doing it. You get a raise, you immediately increase your spending. You get a bonus, you buy a new car. Your income grows, but your savings rate stays flat or even decreases. Financial freedom requires that you save and invest an increasing portion of your income over time. When you get a raise, save it. When you get a bonus, invest it. Keep your lifestyle stable even as your income grows. Mistake 5, paying high fees. Fees compound just like returns, except they compound against you. A 1% annual fee might not sound like much, but over 30 years, it can cost you literally hundreds of thousands of dollars. This is why I recommend index funds with expense ratios under 0.1%. Over a lifetime of investing, keeping your fees low can mean the difference between comfortable financial freedom and struggling in retirement. Mistake 6, making emotional decisions. Fear and greed are the two great destroyers of wealth. Fear makes you sell at the bottom. Greed makes you chase risky investments and over-concentrate your portfolio. If you want financial freedom through passive income, you need to separate your emotions from your money. Make a plan when you're calm and rational, then stick to it regardless of how you feel. Now let me talk about how today's investors can take advantage of modern tools and opportunities while still applying timeless principles. Opportunity. 1, automation makes discipline easier. In my day, you had to physically go to a broker to buy stock, write a check, and wait days for the trade to settle. Today you can set up automatic transfers and automatic investments. Your money moves from your paycheck to your brokerage account to index fund shares without you having to think about it. This is huge. Automation removes emotion from the equation. You're not tempted to time the market or skip months or make impulsive decisions. It just happens. Opportunity. 2, information is free and accessible. When I was starting out, I had to go to libraries and write to companies for annual reports. Today, you can access decades of financial information instantly on your phone. You can learn about investing from world-class resources for free. Use this to your advantage. Read annual reports, study great businesses, learn continuously. The more you understand about how businesses work, the better investor you'll become. Opportunity 3, global investing is easy. You can now invest in international index funds just as easily as domestic ones. This gives you exposure to growth in emerging markets and diversification across different economies. I'd still keep most of my portfolio in U.S. stocks because I understand the U.S. economy and legal system better, but having 10 to 20% in international index funds makes sense for additional diversification. Opportunity. 4, tax-advantaged accounts are powerful tools. Maximize your 401k contributions, especially if your employer matches, that's free money. Max out a Roth IRA if you're eligible. These tax-advantaged accounts can dramatically accelerate your path to financial freedom because your investments grow tax-free or tax-deferred. Opportunity 5-side businesses and online income. The internet has made it possible to start businesses with almost no capital. If you have skills, writing, designing, coding, teaching, you can offer them online and generate additional income to invest. This isn't about replacing your job immediately. It's about increasing your savings rate by earning more. Every extra dollar you can invest accelerates your journey to financial freedom. Let me leave you with the rules I've lived by for over 70 years. These worked in the 1,950 seconds. They work today, and they'll work in the 2,050 seconds. Rule number 1, never lose money. Rule number 2, never forget rule number 1. I know this sounds flippant, but I'm completely serious. The math of losses is brutal. If you lose 50% of your money, you need a 100% gain just to get back to even. This is why I've always been more focused on avoiding mistakes than on hitting home runs. Be fearful when others are greedy, and greedy when others are fearful. When everyone else is euphoric and throwing money at everything, be cautious. When everyone else is terrified and selling everything, be opportunistic. The best investments are usually made when everyone else is panicking. The stock market is a device for transferring money from the impatient to the patient. This might be my favorite observation about markets. Most people can't wait. They want results now. If you can simply be patient, if you can buy and hold for decades, you'll have an enormous advantage over almost everyone else. The first $100,000 is a bitch, but you got to do it. That first $100,000 is the hardest because compounding hasn't had time to work yet. But once you hit that milestone, the acceleration begins. Your money starts doing meaningful work. Every dollar you invest after that compounds on a larger and larger base. Time is the friend of the wonderful business and the enemy of the mediocre. This is why I focus on owning quality businesses with strong competitive advantages. Given time, great businesses compound value at remarkable rates. Mediocre businesses, on the other hand, just consume capital without generating real returns. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Quality matters. I learned this from Charlie Munger. We'd rather pay a reasonable price for a great business, strong brand, competitive advantages, consistent profitability, than get a bargain on something mediocre. So here's the truth about achieving financial freedom through passive income. It's not complicated, but it requires discipline, patience, and time. You need to live below your means and save aggressively. You need to eliminate high-interest debt. You need to invest consistently in low-cost index funds that give you ownership stakes in American businesses. You need to reinvest all dividends. You need to ignore market noise and stay invested for decades. Do these things, and you will achieve financial freedom. Not next year, probably not in 5 years, but over 20, 30, 40 years. You will build a portfolio of assets that generates enough passive income to support your lifestyle without you having to work. Financial freedom isn't about luck. It's not about finding the next Amazon or timing the market perfectly. It's about simple, boring, consistent behavior over long periods of time. Save, invest, reinvest, wait, repeat. That's it. That's the whole strategy. I built my wealth on these principles. Millions of people have achieved financial freedom using these same principles. There's nothing magical about it. It's just mathematics, discipline, and patience. The beauty of passive income is that eventually your money is working harder than you ever could. It's out there 24 hours a day, 7 days a week, generating returns, compounding, growing, while you're sleeping, while you're spending time with family, while you're pursuing your passions, your portfolio is working, your businesses are operating, your dividends are accumulating. That's true financial freedom. You can do this. You don't need to be a genius. You don't need to be lucky. You don't need special connections or a trust fund. You just need to be sensible, patient, and consistent. Start today. Start small if you have to, but start. Set up that automatic investment. Buy that first share of an index fund. Commit to living below your means and investing the difference. 20 years from now, you'll thank yourself. 40 years from now, you'll be financially free. And remember, the best time to plant a tree was 20 years ago. The second best time is today. Thank you, and best of luck on your journey to financial freedom.